In this week's market update, shares rally after the weekend's trade truce, the oil price rises as OPEC agrees further production cuts, and gold falls back as haven assets lose their lustre. Expectations were pretty low going into the Osaka G20 meeting, so the agreement by Presidents Trump and Xi to resume trade talks and postpone the imposition of more tariffs was enough to give shares a boost on Monday. Wall Street hit a new record when it opened, rising nearly 1% to 2,964. Asia had already led the way, with China's CSI 300 index of Shanghai and Shenzhen stocks rising 2.9% after President Trump backed his tariff offer with an easing of his anti-Huawei rhetoric. The main driver of the rally, however, was the decision not to impose a 25% tariff on an additional $300 billion of exports from China to the US, and to restart trade talks that stalled in May. Had those levies been applied, essentially all of China's sales into the US would have been captured by the new tariffs, potentially dealing a heavy blow to profit forecasts in the second half year. Strong technology stocks were a feature in Europe too, as the region picked up on the early gains in the Far East. But gains were achieved across the board, with industrial metals companies also in demand, as expectations rose of a pickup in activity following the trade thaw. The haven assets, which investors had flocked to in the run-up to the G20 meeting in Japan, fell back as risk appetite increased. Gold, which had hit a 6-year high last week, fell by nearly 2%, its biggest one-day fall in a year. The Japanese yen weakened by 0.6% to 108.5 yen to the dollar. Meanwhile, the yield on US Treasuries, which rise as bond prices fall, added 4.5 basis points to take the yield on the 10-year bond to just over 2%. Bonds have been a particular beneficiary of more nervous markets since May. Fixed income ETFs last month attracted inflows of over $25 billion, the biggest monthly inflow on record. It surpassed the previous record set in October 2014 by 45% and took the annual inflow for fixed income ETFs to over $73 billion. While the initial response was positive, there's no shortage of skeptics questioning whether the handshake on the fringes of the G20 summit really changes much. Donald Trump has indicated that he's in no particular hurry to conclude a deal with China. With the US presidential election still 18 months away, there's little pressure on the president to strike an agreement. That nervousness was vindicated on Tuesday as Washington appeared to turn its trade focus to Europe, with a threat to impose additional tariffs on $4 billion of European goods in response to EU aircraft subsidies, which the US considers unfair. Gold bounced back a little, and safe haven currencies like the yen and Swiss franc were marginally stronger. This is a story that looks like it's going to run for a long while yet. Other beneficiaries of the trade truce included the Chinese renminbi, which rose to a 7-week high of 6.8 to the dollar. There had been fears that the Chinese currency would break through what is seen as a psychologically important level of 7 to the dollar. Oil also rose on expectations for easier global trade, although the primary driver of a near 3% rise in the cost of crude was an extension of production cuts ahead of this week's gathering of OPEC oil producers. The curbs on production were introduced in 2016 to counter growing supply from North American shale fields, which have been the principal influence on the weak oil price in recent years. The power of OPEC to manage the oil price has dwindled in recent years as the balance of production has moved outside its membership. The announcement of extensions to the production curbs was actually announced at the G20 summit by Russian President Vladimir Putin. Russia is not an OPEC member, but along with Saudi Arabia, it's increasingly calling the shots among oil producers, to the irritation of Iran, which yesterday warned that the group is becoming increasingly powerless and irrelevant. The oil price is actually on course to average less in 2018 than this year, despite US sanctions hitting production in both Venezuela and Iran, and the introduction of those production cuts. That's a particular problem for Saudi Arabia because it needs oil to average around $70 a barrel for it to balance its budget at a time of expensive investment in reforms to reduce the kingdom's reliance on oil. Not only has Saudi Arabia been prepared to give up market share in order to boost the price, it finds itself under pressure from Donald Trump to keep prices in check. The US president wants to keep the oil price low in the run-up to next year's election. With petrol attracting relatively few taxes in America, changes in the oil price quickly feed through into prices on the forecourts. So managing the cost of crude is an effective way of managing confidence and sentiment in the broader economy. Looking ahead, the current week will see subdued trading in the world's biggest market, with the Independence Day holiday on Thursday kicking off early on Wednesday and probably reducing the impact on Friday of the big economic news of the week, the non-farm payroll employment data. The jobs data will provide an updated view on the health of the US economy at a crucial time for Wall Street. During the first half of 2019, the American stock market has led global markets higher, with a 17% rise in the S&P 500 outstripping the 15% gain for the wider MSCI World Index. US shares left other global indices trailing, with the FTSE 100 rising by around 10% and Japan's Topix faring even worse, albeit just about in positive territory for the 6-month period. Friday's jobs figures are expected to show another 160,000 jobs were created in June. That would be an improvement on the 75,000 created in May, which was the second lowest figure since 2017, and added to fears that the US economy is slowing. Worries that the US economic cycle is rolling over towards recession have driven a sea change in interest rate expectations at the Federal Reserve, where the so-called dot plots that track rate setters' forecasts have swung from flagging 2 or 3 more rate hikes over the next year, as recently as November, to the same number of cuts today. The expectation remains that the first of these cuts could come as early as the next Fed meeting at the end of this month, with some thinking there's a chance of a half percentage point cut rather than the usual quarter-point adjustment. The new worldwide easing bias was confirmed this week by a cut in Australian rates to a record low of 1%, a second cut in 2 months. If the Fed were to cut rates before the evidence starts to emerge of a slowdown in activity, and let's not forget that the US is now enjoying its longest uninterrupted stretch of expansion since the mid-19th century, it will be following the playbook employed in the 1990s by one of the Fed's best-known chairmen, Alan Greenspan. In both 1995 and again in 1998, Greenspan initiated a series of precautionary rate cuts that were credited with extending the economic and the stock market cycles throughout the late 1990s. That was until the bubble finally burst in 2000 at the peak of the dot-com boom. On this side of the Atlantic, a series of economic surveys kicked off in downbeat mood with a slump in manufacturing activity in June as businesses continued to run down inventories that they built up in the run-up to Britain's March Brexit deadline. At 49.4, the Purchasing Managers' Index for Manufacturing, compiled by IHS Markit, stood at its lowest level since 2013. Separately, data from the Bank of England on Monday showed a continuing slowdown in consumer credit growth, although mortgage lending did remain steady. The British economy is in limbo as the Conservative leadership election moves towards a decision later this month when Tory party members will choose between the 2 rival candidates, Jeremy Hunt, the Foreign Secretary, and the current favourite, Boris Johnson.